I want us to discuss bond refinancing. And bond refinancing is a common question in advanced FM exam. But before we do a question on bond refinancing, I want us to just have an overview and an understanding of what bond refinancing is all about. Because as I always say to my students, what is important is to understand and master the concept, because once you get the concept, irrespective of how the question changes, you'll always be in a position to tackle the question, and that is the easiest way of learning. So in whatever you do, focus on just understanding how things work and the key thing about the concept, because that is what is important. Because when you go to the exam, the application of the concept is what makes the difference. So with that said, when we talk about bond refinancing, this is just the process by which companies or governments pay off existing bonds or existing debts by issuing new ones. So generally that is bond refinancing. This is a process by which companies or even governments pay off existing bonds or debts by issuing new bonds. And I think within our context, you've heard of the Kenyan government trying to pay off its debts used by borrowing. And in most cases, companies or governments may want to pay off the existing debt by issuing new ones. And this is usually to take advantage of maybe lower interest rates. So there must be an incentive to do that. But within our government context, I think it is for us to try and understand whether our bond refinancing options is actually adding value or making us worse off, because most people have queried the way we refinance our debts, but it is up to you to decide on that. But at least with that information, you can also be able to have an understanding why will companies want to pay off their existing debts with new debts, or why will government wants to pay off existing debts with new debts. And largely, one possible reason would be to take advantage of low interest rates. That is one incentive, to take advantage of low interest rates. That is one possible reason why company or government may want to do that. Another thing will probably be maybe the terms of the debts are favorable terms of debts, favorable terms of debts, because every debt agreement has different terms. So those can be the different incentives why companies may want to use a new debt to pay off an existing or old debt. So under such cases, a company may have to recall, or a company may want to call an existing debt so that they're able to now use income raised from the new debt to pay off that debt. So in most cases, such a debt, which is in this case is the old debt is always considered to be callable. So when we say a callable debt, is that in this case, this means that the issuer can repay them earlier. So in this case, you can decide, if let's say the debt was maturing in 5 years' time, you can decide to repay earlier than the maturity period. Repay earlier than the maturity period. That is what we mean when we say the debt is callable. If let's say the debt has a period of 5 years, but you decide to pay it way earlier before the 5 years lapses, then that is what we say the debt is considered callable. But because you are paying earlier, or in this case you are repaying earlier, you may be required to pay it off at a premium known as a call premium. So this is the money that now you have to pay in order to exit the debt earlier than what was originally anticipated. So that is what it means when you say the debt is callable. And under bond refinancing, you may find that the issuer in this case may want to pay off the old debt earlier, and they can only do that if they also issue the new debt earlier so that they use the proceeds generated from the new debt to pay off the old debt. That is what we mean by a callable debt. So there's a relation between callable debt and call premium. And sometimes this call premium is also known as a penalty. So every time you see the penalty, it's like saying this is the penalty you pay for exiting earlier than expected. That is more or less the same thing. So the issue of the bond in this case will call the old bond and use it to pay the new one. That is the whole idea. The issuer, which in this case can either be the company or the government, will call the old bond, which we've said at a penalty or at a premium, to pay. And after it, the issuer will call the bond and he pays for the new bond. That is the whole idea. The issuer will call the old bond and pays for the new bond. But for them to do that, they love to issue the new bond first. And so that the proceeds which is raised from the new bond is what now will be used to pay off the old bond. But post these, how do you call it? Once the old bond has been called, so after the calling of the old bond, the only existing bond will be the new bond. And at this point, the assumption is that the new bond should have better terms than the original bond. And for us to do this, we can be able to compare the cash flows that will arise as a result of switching from the old bond to the new bond. And that is the only way now we can be able to advise or to ascertain whether bond refinancing is viable or not viable based on the change in cash flows. So generally what we are saying is this. Let me just give you an illustration so that it becomes very clear. Let me assume that the company issued, let's say the company issued, let's say the old bond, the company had an old bond and it had an 8-year, 10% bond. Let me assume that scenario. And 4 years has already lapsed, or let's say 5 years, so that we don't have it in between. 5 years has lapsed, and this bond is remaining with how many years to maturity? This old bond is remaining with 3 years to maturity. And the company, or in this case, the government, wants to get rid of this old bond. For one reason or another, they may want to get rid of this old bond. And the decision to get rid of the old bond, they may want to issue a new bond. And let's say they will issue a new bond, let's say an 8% bond that has a life of 3 years. So if the company issues an 8% bond that has a life of 3 years, they need to get money from this new issue of this bond so that they use it to pay off this old bond. So for that to happen, the company may have to issue this new bond while at the same time holding the whole bond for some time. So they'll not be able to get rid of this bond immediately, and there is a short duration that will have an overlapping interest between from the time the new bond is issued up to the time the old bond is disposed of. So this overlapping interest in most cases will always be charged within a very short period of time. It can either be in months, let's say it's a 1 month duration. So the company will issue the new bond, but it will still hold the old bond for a period of 1 month. The reason for having this overlapping interest is because you must use the proceeds of the new bond to offset the old bond, so that there's always that time gap where you are still holding the new bond while at the same time still holding the old bond. And that duration, in most cases, it should be a very short period of time. And you realize that even within this duration, interest will still be paid within that short month. So when the new bond is raised, now the company will be able to use the proceeds from this new bond and pay off the old one. So that after the issue of the new bond, the only bond which is existing now will be the new bond. And in most cases, the life of the new bond must always be equal to the remaining life of the old bond. The life of the new bond must always be equal to the remaining life of the old bond. The reason why this is the case is because you should be able to compare the opportunity cost of the cash flows foregone from the old bond against the cash flows that the new bond will generate. That is why you'll always find that the new bond's maturity period must always be equal to the life that the old bond could have lived, assuming it was in existence. And this principle still applies to what we did under replacement of asset, if you remember. It is more or less the same thing, because we said under replacement of asset that the life of the new asset should be equal to the remaining life of the old asset, and even bond refinancing still applies the same principle. So that is it on bond refinancing. So if you are asked a question on bond refinancing, there is a procedure for bond refinancing, just like what we said in replacement of asset. We must also use the incremental cash flow basis or the incremental cash flow approach and try to compare the cash flows as a result of then by introducing the new bond and disposing the old bond. So in our computation, the first computation we must always have is the initial cash outflow. This is the initial cash outflow. This initial cash outflow is the initial cash outflow as a result of the issue of the new bond. And this initial cash outflow, what forms this initial cash outflow? So the first initial cash outflow we've said is that because you want to introduce the new bond, you must get rid of the old bond. And in that case, because you are disposing the old bond earlier than when you could have disposed it, you'll have to pay a call premium or a penalty on the old bond. And this call premium or penalty is more of a prepayment because you are paying earlier, you are exiting earlier than you could have left. That's why it is a prepayment or penalty on old bond. In addition to that, we've said we have the overlapping interest. And the reason for overlapping interest, we said, is that there is that period when you've issued the new bond, but you're still holding on the old bond, so that there's a duration where interest will be paid on both the new and the old bond. So in that case, we have the overlapping interest. But let me just say something about these overlapping interests, because I've had instances where it's never clear what it really means, because these overlapping interests are I can use this example where I used 1 month. Within this 1 month duration before paying off the old bond, you'll realize that the company is holding both the old bond and the new bond. So it needs to pay a 1 month interest on the old bond before exiting. But because he's holding the new bond, in most cases, we don't recognize the overlapping interest on the new bond because the new bond is a future cost. And the reason why we are saying it's a future cost is because you'll still be paying interest over the future years. And that is why you'll realize that when talking about overlapping interest, you always take only the overlapping interest on the old bond and not the new one. And the justification is that the new bond, you'll still continue holding it and you'll still pay interest on it in future. And in any case, that interest, you're paying it on annually. So you'll be able to pay interest every year until the new bond matures. But for the old bond, you want to get rid of it. So the interest is already committed cost. So we consider it more of a sunk cost. That's why you'll realize that every time you are charging overlapping interest. So don't worry about the new bond, but just take the overlapping interest on the old bond, because I've always had instances where people are always wondering why are we taking the overlapping interest on the old bond and not the new one. Remember, by the time you are holding the new bond, you will have already gotten rid of the old bond. It will not be existing. So that is the justification for that. So we'll have the overlapping interest on the old bond, but remember this overlapping interest, you only need to charge it on the duration, on the short term duration. And in most cases, this overlapping interest is always in months. So please remember that this overlapping interest, you have to charge it in months. And I've rarely seen instances where it is in years. I doubt if that is possible because it is always a very short period from the time you switch to the new to the old. That's why in most cases it's in months. Then in addition to that, you may also have to issue the new bond, and sometimes to make the issue of the new bond to be attractive, you may incur discount cost or flotation cost. So in addition to that, we'll have the discount cost on the new bond. And please note we are saying discount cost on the new bond. At the same time, you may also incur flotation cost. Flotation cost on the new bond. Sometimes if they don't say it flotation cost, the question can call it issue cost on the new bond. Issue cost is still the same thing. Flotation cost on the new bond, issue cost on the new bond, there is no difference. It is still one and the same thing. So from there now we'll have our gross initial cost. We'll have our gross initial cost. But because of the interest being paid on the bond and their related cost on the interest, we must always less the tax shield benefit. So from our knowledge of taxation, we know that every time a company pays interest, there is a tax benefit that they are paid as, because remember, interest is a necessary expense that needs to be paid on the debt. But to take advantage of that cost or that finance cost, the company can add back part of that payment in form of a tax benefit. And the tax benefit is charged on interest, no, but not only interest, but even any other incidental costs related to interest. And these incidental costs can be the call premiums, the discount costs, and the issue cost, etc., etc. So within the context of the initial investment, the tax benefit will be charged on the call premium that was paid as a result of exiting earlier. It will also be charged on the overlapping interest. And we've already said which overlapping interest. We only take the overlapping interest on the old bond. Then it can also be charged on the unamortized flotation cost. Unamortized flotation cost. And this unamortized flotation cost is not just any unamortized flotation cost, but it is related to the old bond. So why are we saying unamortized flotation cost? Let me use this illustration. Remember, if you dispose this old bond, for example, in the fifth year, there is 3 years that this bond could have been amortized. Amortization just is a simpler way of just talking about depreciation of something of that sort. So if this bond is disposed of earlier, there is 3 years that it could have been amortized, but it has not been amortized. So there is an amortized flotation cost on the old bond. There is an opportunity cost of not amortizing fully the flotation cost and the discount cost. So any cost which is not amortized on the old bond, where the discount cost or flotation cost will be added to our tax shield benefit before we charge the tax. So please let's note that it is the unamortized flotation cost of the old bond and also an amortized discount cost on the old bond. And everything is on the old bond. And how do you get these unamortized flotation costs on these two bonds? Let me just explain this. In most cases, amortization will follow a straight line. So for you to get the unamortized flotation cost, you'll have to get the flotation cost per annum. Then you multiply by the years, the remaining life of that bond that was not. Then you multiply by the remaining life of that bond that it did not live. For example, if I use this my illustration, after getting the flotation cost per annum, 3 years of it has not been amortized because it was disposed after 5 years. So if let's say my unamortized flotation cost per annum was let's say 0.1 million, then I'll say 0.1 million times 3, which is the remaining life. That will give me the unamortized flotation cost on the old bond. The same case, in case we had the discount cost, maybe it's 0.5 million. I'll say 0.5 million times 3 years. That will give me. Sorry, please let's note that after getting the unamortized flotation cost per annum, you multiply by the remaining life that bond could have lived if it was held up to maturity. Then after summing all these tax benefits, you'll take these plus that, plus that, plus that. Then you charge corporation tax rate. And when you charge corporation tax rate, this will give you the tax benefit. And now you minus from this. And this is how you get the initial cash outflow as a result of introducing the new bond. So that will be your step 1. After getting the initial cash outflow as a result of introducing the new bond, now we have to compare the cash flows or the cost savings that will arise as a result of using the new bond. And for us to get the cost savings, we have to compare the cash flows due to the old bond. So we are trying to establish whether there is an annual cost savings as a result of introducing the new bond. So we have to compare the cash flows of the old bond against the cash flow of the new bond. And remember, by the time you're comparing the cash flows of the old bond, you've already called this bond, so it does not exist. That's why we always compare it with the opportunity cost of the cash flows that this bond will have generated. That's why, remember, I said that the life of the new bond must always be the same as the life that the old bond could have lived, so that you can be able to compare the cash flows of the new bond against the cash flows that the old bond could have generated if it was held to maturity, so that you see whether there is actually a benefit that comes from using the new bond or not. So for us to do that, we'll start by getting the cash flows of the old bond. And another important thing which I have to emphasize is that if you're getting the cash flows of the old bond, every component of cash flows must be per annum. Please let's not forget this part. Every component of cash flow must be per annum so that it will also give you an annual cost saving. So please note that it must be per annum. So let's start with the first item, which is the cash flows of the old bond. So if you want to get the cash flow of the old bond, we'll take the interest on the old bond. We'll take the interest on the old bond. Then after taking the interest on the old bond, we'll also less the tax shield benefit, just like we said previously. And this tax shield benefit, we'll charge it on, first of all, we'll charge it on the interest. Then we'll also charge it on the amortized discount. Please let's note that we are talking about the amortized discount. And this amortized discount is the amortized discount. In this case, we are talking about the old bond. It is the amortized discount of the old bond. But remember, everything must be per annum. The amortized discount of the old bond per annum. And also we can add the amortized flotation cost. And this amortized flotation cost, or it is also per annum, and everything in this case is on the old bond. Everything we are talking about the old bond, and remember we are saying it has to be per annum. And this time round it is amortized, not unamortized. Amortized means that the one that has been. Remember, every time you see amortization, just relate it more or less to depreciation. And by the time you're talking about the amortized flotation cost, now it will be based on this life. For example, in this case, if it was 3 years, we'll divide it by 3 years. Because now the old and the new bond have the same lifespan. So that is why we are saying the amortized now will be basing it on the normal life of the bond. And remember, we are saying that it is per annum, so really doesn't really change because it is always on straight line method. And we know that if you're using straight line method, the rate every year will be the same. So even if it doesn't matter the period, what is important and we're emphasizing is that it has to be per annum. Then you multiply by the tax rate. Then now you less the tax benefit. And this will give you now the net cash flow as a result of the old bond. Then you also look for the cash flow on the new bond. Cash flow on the new bond. So if you look for cash flow on the new bond, the cash flow on the new bond will start by taking the interest on the new bond. Interest on new bond. Then from the interest on the new bond, we also less the tax shield benefit. Then you less the tax shield benefit. The tax shield benefit will be charged on the interest, and remember it has to be per annum. And it will also be charged on the amortized flotation cost, but remember the amortized flotation cost, it's on the new bond. Everything is new. And we are saying this one also has to be per annum, and it is on which bond? The new bond. Then if the question provides, you can also have the amortized discount cost. And this amortized discount cost is also per annum, but on the new bond. Then once you've done that, you sum up everything, then you charge the tax rate. When you charge the tax rate, now you'll proceed unless to get the cash flows as a result of the new bond. So we'll take the cash flow, we'll compare the cash flows of the old bond and the cash flows of the new bond so that we try to establish whether there is an annual cost savings. So the annual cost savings will be as a result of the cash flows of the new bond minus the cash flows of the old bond, or the net, or alternatively we can call it the net cash flow. And this cash flow is also per annum. So after getting the cash flows per annum, then now we can proceed and get the NPV. We'll now take this annual net cash flow times the present value interest annuity factor, NR%, we minus the initial investment that we already got in our workings. So the N will definitely be the life of the new bond, which is the same as saying the maturity period of the new bond, which we say it is always the same as the remaining life that the old bond could have lived if it was in existence. Then the R% that we use is, we are not using the normal discounting rate, but the cost of debt after tax. It has to be the cost of debt after tax. If the question gives you the cost of debt without charging tax, then you can get the cost of debt after tax by just taking the rate into 1 minus T, or as we always say, KD into 1 minus T. This gives you the cost of debt after tax. And remember, if your cost of debt after tax is a decimal value, then there's a very high chance that when you go to your table, you may not find that rate in the table. And remember what we said, just like what we said under investment appraisal, under inflation. If the rate is not in the table, then you have to replace in the formula, because that is the only way around it. And if you replace in the formula, you make sure that your answer is in 4 decimal places. Then from there, now you compute your NPV. And as always, the NPV can either be positive or the NPV can either be negative. The NPV can either be positive or the NPV can be negative. So if the NPV is positive, definitely it means that there is the bond, the replacement of the old bond with the new bond actually has value for money, and that is a viable option. But if the NPV is negative, then it means that the replacement does not guarantee value for money and therefore is not a viable option. So that is the procedure for bond refinancing, where you replace an old debt with a new debt. And in most cases, you expect that the new debt should always have a lower interest rate as compared to the old debt, so that we justify that it is actually cheap. But the justification of cheapness is not sufficient enough to say that it is a viable option to replace the bond. That is why we have to proceed and get the NPV, so that it is only at the point of determining the NPV that we can be able to now give an advice on whether the bond should be refinanced or not. So once you've understood this concept of bond refinancing, now you've already solved the most important part of bond refinancing, so that now I'll only do one illustration question. Then now on your own, you can be able to attempt others. And generally that is it. So in the next session, I'll be looking at how do we compute now an actual question on bond refinancing. So I want us to do a sample question on bond refinancing, and a sample question. This is November 2019, question 4C. So we are saying November 2019 4C. Smooth Drive Limited, a motor vehicle assembling company, issued a 10-year 16%, 100 million par value bond 5 years ago. The bond was issued at 2% discount, and the issue cost amounted to 2 million. Due to decline in treasury bill rates in the recent past, interest rates in the money market have been falling, presenting favorable opportunities for refinancing. Financial analysts engaged by the company to assess the possibility of refinancing the debt reports that a new 100 million par value 12% 5-year bond could be issued by the company. The issue cost for the new bond will be 5% of the par value at a discount of 3%. Will have to be given to attract investors. The bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid on redemption. All bond issue expenses, including the interest penalty, are amortized on straight-line basis over the life of the bond and are allowable for corporation tax purposes. The applicable corporation tax rate is 40%, and the after-tax cost of debt to the company is approximately 7%. So the first part is the initial investment required to issue the new bond. So that is actually what we did by computing the initial investment. So I want us to use now this question to explain what we just said previously. So first things first, we are saying that there was an original bond, and this original bond, we are told that the company issued a 10-year bond, a 16% 10-year bond 5 years ago. So you can see that 5 years has elapsed since this bond was issued, and originally the company issued a 16% bond. So this bond is remaining with, it was issued 10 years ago. There's a 10-year 15% bond. So even before we introduce the new bond, as at this time, this bond only has 5 years to maturity, 5 years remaining. But the company wants to replace this bond now. And the decision to replace the bond is that the company, there is favorable interest rates that are declining, and they're seeing an opportunity to take advantage of these favorable rates, and they want to issue a new bond. And we are told that this new bond, it will be a 5-year 12% bond. So the company wants to issue a 5-year 12% bond. So this is the new bond. And remember what we said, the life of the new bond should be equal to the remaining life of the old bond, so that we can be able to compare cash flow. So it is exactly consistent with what we've said. And you can see that this new bond, the interest rate is 12%, and this one is 16. So you can see that based on the interest rate, we can see that this bond is considered cheap. And based on the interest rate, this bond is considered to be expensive, depending on how you want to look at it. So, but for that bond for the new bond to be issued, the company must redeem or must call this old bond earlier. So this bond will be called earlier, and we are told that the company will have to call the bond earlier, and that is, if you look at the old bond can be redeemed at a 10% premium. So because you are recalling the bond before the 5 years lapses, you have to now pay a premium on it. And for you to redeem the bond, because you want to use the proceeds of the new bond to pay off the old bond, you'll be holding both bonds at the same time for a duration of how many months? 2 months. So in 2 months, you'll be having the two bonds, and there will be an overlapping interest for a period of 2 months. And the reason for that is because you need the proceeds of this new bond to pay off the old bond. So within these 2 months, you'll have to pay an overlapping interest on the old bond before you fully dispose it. So based on that information, now let's start by computing the initial investment required to issue the new bond. Initial investment required to issue the new bond. So for us to get the initial investment required to issue the new bond, we'll start by getting the call premium on the old bond because you have to get rid of that old one. And what were we told about the call premium? The old bond, let me be very specific and say on old bond. The call premium on old bond is that there's a 10% premium. So this 10% premium is 10% of the par value of that old bond. And what was the par value of the old bond? What was the original par value of the old bond? The company issued a 10-year bond, 16% with a 100 million par value. So the old bond had a par value of 100 million. So if that is the case, it means the call premium on this bond will be, the call premium of this bond will be 10 million. Then we remember we talked about the overlapping interest, and we said this overlapping interest is only charged. This overlapping interest is only charged. This overlapping interest is only charged on the old bond, and we said why we are charging it on the old bond. So I think I'm quizzing my workboard, so let me zoom out a bit. I think this is what is causing the problem. Just a minute. Okay. So the overlapping interest on the old bond will be, we are told this interest is for what duration? We are told the interest is for duration of 2 months. What were we told? Let's go to our information where we were told. Let's see. The old bond can be redeemed at 10% premium, and in addition, 2 months interest penalty will have to be paid on redemption. So we have to pay the overlapping interest, but this interest will only be paid for what duration? It will only be paid for 2 months. But what is the rate of interest on the old bond? The old bond interest rate is 16% per annum. So we'll have 16% of the 100 million, but the only difference is that this interest is being paid for what duration? For 2 months. So what is our overlapping interest? So for us to get the overlapping interest, we know that it is 16%. 16% of 100 million we know is 16 million. So we just need the 16 million times 2/12 because we only want it for 2 months. And this is 2.67 million. So that will be the overlapping interest, 2.67 million. And remember, we are saying these overlapping interests. Please let us not forget it is on the old bond. And I explained why it is on the old bond, if you remember, while I was giving an introduction to this. Then another thing we have to consider is whether there is an issue cost on the new bond. Issue cost. Issue cost is the same as saying flotation cost, and I think there was somewhere we were told there is an issue cost, and in this case we are talking about the issue cost on the new bond. So what is the issue cost on the new bond? We are told that a 12% 5-year bond will be issued by the company. The issue cost will be 5% of the par value, and the discount will be 3%. So the issue cost is 5% of the par value. And we know that the par value is 100 million. So 5% of 100 million. That is definitely 5 million. That is the issue cost. And at the same time, we are told there is also a 3% discount cost on the new bond. So we have discount cost on new bond, which is also 3% of the par value. Let me see, what was the par value of the new bond? Let me just confirm that it was actually 100 million. So the new bond also has a par value of 100 million. So that one is okay. So that is 3% of 100 million. And that should be 3 million. So when you sum up that, it will give us the gross initial investment before we less the tax benefit. So the gross initial investment will be the 2.66 plus the 10 million plus the 5.35 plus 3, which is 8 million. So that we have an initial investment of 20.67 million. Then from this initial investment, now we less the tax shield benefit. Less tax shield benefit. And remember, we said the tax shield benefit is charged on interest and all the incidental costs related with interest, such as the deflation cost and the discount cost. So we'll start by having our call premium, which we know the call premium is, our call premium we say it is 10 million. Then we also have the overlapping interest, and remember this call premium is on the old. We also have the overlapping interest, which we are charging on the old bond also, which we got 2.67. Then we said we also have to recognize the unamortized flotation cost on the old bond. Remember, this old bond was issued 5 years ago, so 5 years is remaining. So in case there was flotation cost which was incurred on this old bond, then it means that of these remaining 5 years, there is part of the flotation cost that will not be amortized, and therefore we also need to have a tax benefit on that. So let's have, first of all, we need to identify whether there was any flotation cost on the old bond. So if you look at the first part, the bond was issued at a 2% discount, and the issuing cost amounted to 2 million, and this issuing cost is the same as saying flotation cost. So there was a 2% discount cost, and there's a 2 million flotation cost on the old bond. So we need to identify the unamortized. Let's start with unamortized flotation cost. Remember, flotation cost is the same as saying the issue cost. So the normal issue cost was 2 million, but it is 2 million for a period of for the full maturity period of the bond, which we know is 10 years. So if you are to get the amortization per annum, then it would mean that it is 2 million divided by the 10 years of this bond, which means that it is 0.2 million per annum. But this bond was only held for 5 years, which means 5 years was remaining before it was fully amortized. So the unamortized flotation cost will be 0.2 million times the 5 years remaining. Please let's note it is the 5 years remaining. If it is 5, it may look like it is the other 5 years, but it is the last 5 years, which means that the unamortized flotation cost will be 1 million. And we also look for the unamortized discount cost. The unamortized, and remember we are talking about, in this case, this is the old bond. Then we have the unamortized discount cost. And this unamortized discount cost, the question has told us that the old bond was issued at a 2% discount. So first of all, we have to identify 2% of the original par value of this bond, which was 100 million. So 2% of that is still 2 million. And the old bond had a life of, okay, it also had still had a life of 10 years, which means that it will still be 0.2 million per annum times 5 years, which makes this to be 1 million. That is also the unamortized discount cost. These 5 years, remember, it is the remaining 5 years. So what is the total cost that qualifies for the tax benefit? It will be 10 plus this plus that plus that. So what will be the total cost that qualifies for the tax benefit? This will be 10 plus 2.67 plus, in this case, this is 2 million. So that we have 14.67 million. Then we charge corporation tax rate. And what is our corporation tax rate? The applicable corporation tax rate is 40%. Then we get 40% of that, so that we get the tax shield benefit. So this will be that answer that we get. We multiply by 0.4. We get 5.868. 5.868 million. And that is what now we'll subtract from this. So when you minus from that, we get now our, when you minus from that, now we get the net initial investment required. So this gives us the net initial investment required to issue the new bond. Required to issue the new bond. And we minus 20.67 from our answer. So 20.67 minus our answer, we get 14.802. 14.802. So this is the net initial investment required to issue the new bond. That is how we answer Roman 1 of the question. Then Roman 2, the question is asking us to get the annual cash flow saving, if any, expected from the bond refinancing. So for us to get any cash savings or any cost savings, remember we said for there to be savings, the cash flows of the old bond. We compare the cash flows of the old bond must be greater than the cash flows of the new bond. And in this case, it means, remember, the cash flows of this old bond is cost of the old bond must be greater than the cost of the new bond, so that this new bond now gives rise to a cost savings. So let's try to see whether there is a cost savings by first trying to get the cash flows from the cash flows on the old bond. So if you want to get the cash flows on the old bond, we start by getting the interest on the old bond. And we know the old bond had an interest rate of 16%, and it had a total par value of 100 million. So that it had an interest rate of 16%, so that now an interest rate of 16%. In this case, we have a total interest of 16 million. Then we less the tax shield benefit. We less the tax shield benefit. We less the tax shield benefit. So when you less our tax shield benefit, the first item we'll start with is definitely the interest, which you know is 16 million. Then we have the annual, we said that for the interest tax shield benefit, we have to add the amortized discount or flotation cost. So we need to add the amortized. Let's start with the amortized flotation cost. But remember, we are talking about the old bond. Already we know the flotation cost per annum of the old bond. We already got it to be 0.2 per annum. Remember, at this point we said everything must be per annum. So let's not forget that part. Even the amortized flotation cost of the old bond, it has to be 0.2 per annum that we already computed. And also we need to get the amortized discount cost of the old bond that we also got to be, if you remember what we already computed it here, the amortized discount cost per annum was 0.2 million on the old bond, so we don't need to calculate it again. So that in that case now we get the total, which is 16.4 million. Then now we multiply by corporation tax rate, which is 40%. So you just need to get 40% of 16.4. So 16.4 million times 0.4. We get 6.56. So that is what we'll subtract as the tax benefit, 6.56 million. So we'll take 16 minus 6.56. So we'll say 16 million minus our previous answer, which is 9.44. So 9.44 million is the cash outflow of the old bond, which is the same as saying the cost per annum. Remember, this is per annum. We said everything has to be per annum. Never forget this part. Everything has to be per annum. So let's also get the cost per annum of the new bonds. So I can just have it beside here so that I save on my work area. Cash flow on the new bond. And I'll start by getting the interest. And the interest on the new bond. The interest on the new bond. What was the interest rate? We say the interest rate on the new bond. The interest rate on the new bond, we said is what percent? We said it's 12%. So it is 12% of the par value, which the new bond also had a par value of 100 million. So in that case, automatically it means that this interest is 12 million per annum. Then we also less the tax shield benefit. And the tax shield benefit will first of all charge it on the interest, which we know is per annum is 12 million. Then we check whether there is any amortized flotation cost. Remember, the new bond also had a flotation cost. So let's have the amortized flotation cost. And this time around, remember, we are talking about the new bond. So we are using straight line method. So what was the flotation cost on the new bond? The new bond had a flotation cost of how much? I think we wrote it somewhere before. The issue cost on the new bond in total was 5 million. This one here. But now we want to amortize it. Remember, the new bond has a maturity period of 5 years. So if you want to get it per annum, it is actually 5 million divided by 5 years. And that is how we end up with 1 million per annum. Then we also need to consider the amortized discount cost on the new bond. Remember, it also had a discount cost. And we are saying everything has to be per annum. So we already computed the amortized discount cost, if you remember. And our amortized discount cost was 3 million, this one. Sorry, not the amortized, but the 3 million was the total discount cost before we amortize it. So amortization, the question told us it's on straight line. And this bond has a life of 5 years. Remember, the new bond has a life of 5 years. So in such a case, we'll have to take the 3 years. Sorry, not the 3 years, but the 3 million we divide by 5 years. 3 divided by 5, that should be 0.6 or something like that. Let's see, 3 divided by 5. That should be 0.6. So that is 0.6 every year. So when you sum up, what do you get? When you sum up these, you get 13.6 million. Then you multiply by 40%. So when you charge 40% on it, what do you get? When you take 0.4 times 13.6, we are saying 0.4, which is the corporation tax rate, we multiply by 13.6. You get 5.44. So that is our tax benefit, 5.44. Now we need to minus the 5.44 from this. We need to subtract it from this, the same way we subtracted this from that. So what do we get when you 12 minus, then we take 12 minus 5.44. 12 minus our answer, we get 6.56. 6.56 million. So the cost of, and remember it is per annum, the cost of the old bond per annum is 9.44 million, and the cost of the new bond per annum is 6.56. So we can actually get the cost savings per annum. What is the cost savings per annum? The cost savings per annum will just take the 9.44, we minus our answer. So that you get 2.88 million per annum. For how many years? For 5 years, which is for 5 years, which is the life of, for 5 years, which is the life of the new bond. So now that we've gotten the annual cost savings, the next step now is to get the NPV, and by getting this answer, we've actually answered Roman 2 of the question. So now we can proceed and get the NPV, because this cost savings is equivalent to our net cash flow per annum. So we take the net cash flow per annum, which is the cost savings on debt, times present value interest annuity factor, NR%. But this time round, we'll use the cost of debt after tax as our discounting rate, we minus the initial investment. And the question has already given us the cost of debt after tax. And if you look at the question, we were told that the after-tax cost of debt is 7%. So now that the question has given us the after-tax cost of debt to be 7%, we'll just proceed and get our NPV. And I think now from here, everyone else should be very, very safe, because we've talked about computing NPV one too many times in class. So from here, everything else should look very, very familiar. And now we just go to our table and read our answer. We minus the initial investment. And what was our initial investment? The net initial investment was 14.802. 14.802 million. So we need to go to the annuity table and read 7% for 5 years. But in case you don't have the table with you, like I don't have the table right now, we can just compute it manually. But I don't expect you to do this manually if the table is already there, so you don't need to complicate this process. The only thing I said, if your rate is in decimal point, then in this case you are forced to do it. You are forced to calculate it manually, because you cannot have a decimal value in that present value table. So you'll have no option but to calculate manually. So we'll take 1.07 raised to the power negative 5. 1.07 raised to the power negative 5. Then the answer that I get, 1 minus answer, I divide by 0.07. I get 4.1001. So if I round it off in If I round it off in 4 decimal places, I can say 4.1002. So this will be 2.88 times 4.1002. Then I minus the net initial investment of 4.802. And this will give us the NPV. So our NPV will take, okay, let me just use the value as it is in the calc, but there's no problem. You get the idea. Times that, I minus 14.802. I minus 14.802. 802. In this case, I'm getting a negative value. I'm getting negative 2.9934. Negative 2.9934 million. So, in relation to bond refinancing, remember the last part of the question, advise the company on whether to refinance the bond based on your results. So because we are getting a negative NPV, the advice will be the company should not refinance the bond. Should not refinance the bond because the reason is what matters. Remember, the NPV talks about value maximization objective. And we say that value is maximized when the NPV is positive and value is lost when the NPV is negative. So in this case, it means that the bond loses value by 2.9934 million. And that is now the justification. The company should not refinance the bond because it loses value. There's no value for money. That is what we're trying to say. It loses value by 2.9934 million. And therefore, there is no value for money on it. And therefore, there is no value for money. Because NPV talks about value maximization, and even from a financial management point of view, the goal is to maximize value to the investor. So the investment in the bond is not maximizing value to the investor because it loses 2.9934 million, and therefore they should not refinance the bond. So that is it on how you answer bond refinancing question. So I want to give you an assignment so within the context, you can also, from our Kenyan context, you can ask yourself whether our government bond refinancing has value for money or not, in case you ever wondered how bond refinancing works. So you have a basis of querying how the Kenyan government refinances its bonds. But that notwithstanding, we have to pass first before we start querying the government on how bond refinancing is done. So to make us understand bond refinancing, I want you to try out this assignment. And this is December 2024. This is the most recent sitting. Question number, this is also 4C. I think they have an issue with 4C because the other one was also 4C. So try out December 2024 question 4C. And now you have the concepts and the basic of bond refinancing, and you should be able to answer this question comfortably. But in case you have any question, feel free to ask. Thank you very much.